I'm not going to beat around the bush. I'm just going to tell you guys straight up. It looks like the economic data tomorrow morning could have been leaked today. Now, tomorrow morning, we get durable goods orders. We're expecting a negative 1% decline. And we'll talk about all of this throughout this video, but I just want to give you a little bit of a heads up here because the Dow is selling off. Russell's selling off. Economically sensitive areas, interest rate sensitive areas of our markets are selling off today, at least down a lot more than the S&P and the NASDAQ. Whereas today, we actually had better than expected economic data across the board. Things actually looked pretty good today from the data that we got. So you wouldn't expect to see that. You would expect small caps and cyclicals to outperform. Here's the kicker though. 10-year treasury yields are down 5 basis points today. That should not happen with better than expected economic data. And there's really no reason that 10-year treasury yields are falling 5 basis points today, which is a big move in Bondlandia. It would make sense, although, if that data tomorrow with durable goods orders is going to be bad. If that data tomorrow is going to be bad, even worse than expected, that would make sense why cyclicals and small caps are selling off. That would make sense why 10-year treasury yields are falling and tech to some degree is outperforming. It almost looks like the data was leaked today. And we'll discuss all of this throughout this video. First and foremost, it is worth mentioning last night's earnings and this morning's earnings came in really good. UPS, seen as one of those bellwether companies for the economy, is currently up 5%. ServiceNow is up 6%. Whirlpool, another economically sensitive company, up over 12% today. Tesla up almost 20%. You would not expect the markets to be having a weak day. And check this out. Almost every single economic data point we got today came in better than expected. Let's start here. Chicago Fed National Activity Index came in at negative 0.28. We were expecting positive 0.2, but that's really not a big deal. Initial jobless claims came in at 227,000. The estimate was 242,000, so well below estimates there. Continuing jobless claims did come in higher than estimates at 1.897 million. The estimate was 1.88 million, so slightly higher on continuing jobless claims, but markets really look at initial jobless claims more than anything. S&P Global Composite PMI came in at 54.3. The estimate was 54, so that was a beat. Manufacturing PMI came in at 47.8. The estimate was 47.6, so that was a beat. Services PMI came in at 55.3. The estimate was 55, so that was a beat. New home sales for September came in at 0.738 million. The estimate 0.72 million. That was a beat. New home sales month over month came in at positive 4.1% versus estimates of negative 2.2%. That was a beat. Kansas Fed Composite Index came in at negative 4. The estimate was negative 6. That was a beat. Manufacturing Index for the Kansas Fed area came in at 0. The estimate was negative 16. That was a massive beat. So what happened today? Well, some of the weakness has to do with the underlying report in the S&P PMI. So in the employment sector, employment fell for a third straight month in October, though the decline was again only very modest and less than reported in August and September. That is causing some fears about the economy and about the labor markets today. Which that makes sense why the Dow is down 0.5%, and the Russell is also down 0.2%. Both of these indexes interest rate sensitive, but really economically sensitive, selling off. NASDAQ is up 0.55% today, whereas the S&P is up 0.10%. The NASDAQ partially being held up by some of your big tech stocks like Meta up 0.5%, Amazon up 1.2%, Google up 0.3%, Nvidia that is slightly in the green today. What's dragging the NASDAQ down a little bit is Apple down 0.4% and Microsoft down 0.2%. Why I think today is really a bad day for markets and a bad setup is because we did gap up upon this economic data, and then we sold out off to start the trading day. Now, we still have some time left. If markets rally towards the end of the day, that looks pretty good. But on a technical basis, you continue to butt right up to this white line here. That is the 20-day moving average. You did find support here today, like right on the 20-day moving average at 576.72 on the SPY. So that's good, but it does look like you're setting yourself up for a move lower to that 50-day moving average, especially following a day like today where we had so much good data and the markets didn't really react that good. When you start to kind of ignore good economic data, it can be a sign of more weakness to come. And I won't say we're completely ignoring this because the NASDAQ is up quite a bit today, but the S&P, broadly speaking, is ignoring the good data. And I mean, this is not really too much of a crazy call considering we are heading into the election here soon, and next week is going to be huge for expectations around the election. People are going to start moving their portfolios in accordance to who looks to be the party to take the Senate and the White House. Now, beyond that, I'm still concerned that Apple Intelligence next week is not going to impress investors. Investors before yesterday were expecting a big refresh cycle from Apple Intelligence, and that just means people go out and buy the new iPhone, right? Apple really hasn't had a big refresh or upgrade cycle in the last couple of iPhones, so people really thought it was going to be the iPhone 16. Yesterday, Apple dropped news that they are really projected to sell 10 million less iPhones than previously expected, and it was actually an Apple analyst that said Apple is not ordering 10 million iPhones as they were previously expecting. So that kind of caught the markets by surprise. Now, the problem with Apple Intelligence coming next week, if it is not a wild success, is you're going to start to get companies that doubt, or investors that doubt companies spending into AI. And we will start to get more of your big tech names. Next week is the week for earnings. You also have earnings expectations for these big tech companies very high. So it's going to be hard to really impress investors. One of those situations where if you don't impress and things are just good or okay, it's probably not going to be enough to justify further upside, which in those scenarios, you tend to get downside. And I think that is the risk for the markets here at this point. You mix potentially just okay big tech earnings with a flop from Apple Intelligence, and you could be looking at the start of a large correction. And that is my prediction I made on October 21st, that I do believe we are in the starting phases of a 10% correction. Now, I do actually have some good news today, though. 10-year Treasury yields are trading down almost 5 basis points, down to 4.2% if we're rounding here. Now, as long as 10-year Treasury yields do not continue to move higher, you could see a rotational correction. That could be big tech selling off a little bit and the rest of the markets catching a bid. That would be really healthy. But if we get a correction that involves 10-year Treasury yields actually moving higher and they don't continue to fall from here following today, then you're not going to get that rotational correction. You're just going to get a correction. So I think that's what we really want to be watching out for is, do we get a rotational correction or do we just get a correction? It is being reported that U.S. home sales are on track for the worst year since 1995. And Renaissance Macro Research says labor softening ahead. According to the Conference Board's Q4 2024 CEO Confidence Survey, 26% of survey respondents see a net reduction in the workforce over the next 12 months. This is the highest level since Q4 of 2020, with what has been a pretty consistent uptrend throughout 2024. Liz Young Thomas writes on X, the latest Fed beige book was generally more hawkish than the prior two, with businesses noting an expected improvement in conditions after the election. The Fed relies on qualitative info like this to contextualize hard data, so the recent move up in yields makes sense. And I will read you part of the overall economic activity summary from the Fed beige book that came out last night. It says, on balance, economic activity was little changed in nearly all districts since early September, though 2 districts reported modest growth. Most districts reported declining manufacturing activity. Activity in the banking sector was generally steady to up slightly, and loan demand was mixed, with some districts noting an improvement in the outlook due to the decline in interest rates. Reports on consumer spending were mixed, with some districts noting shifts in the composition of purchases, mostly towards less expensive alternatives. Housing market activity has generally held up, inventory continued to expand in much of the nation, and home values largely held steady or rose slightly. Still, uncertainty about the path of mortgage rates kept some buyers on the sidelines, and the lack of affordable housing remained a persistent problem in many communities. Commercial real estate markets were generally flat, although data center and infrastructure projects boosted activity in a few districts. The short-lived dock workers strike caused only minor temporary disruptions. Hurricane damage impacted crops and prompted pauses in business activity and tourism in the southeast. Agricultural activity was flat to down modestly, with some crop prices remaining unprofitably low. Energy activity was also unchanged or down modestly, and lower energy prices reportedly compressed producers' margins. Despite elevated uncertainty, contacts were somewhat more optimistic about the longer-term outlook. So this Fed beige book actually sounds a lot better than last month's, where it just sounded really bad. Now, economic activity on balance was little changed since September. So they're still going with, things are not great out there. Most districts are actually declining in their economic activity, but this does seem like a slight improvement nonetheless. On labor markets, it says, on balance, employment increased slightly during this reported period, with more than half of the districts reporting slight or modest growth, and the remaining districts reporting little or no change. Many districts reported lower worker turnover, and layoffs reportedly remain limited. Demand for workers eased somewhat, with hiring focused primarily on replacement rather than growth. Worker availability improved as many contacts reported it had become easier to find the workers they needed. However, contacts noted that it remained difficult to find workers with certain skills or in some industries such as technology, manufacturing, and construction. Wages generally continue to rise at a modest to moderate pace with the improvement in worker availability. Contacts in multiple districts pointed to a slowdown in the pace of wage increases. Still larger than usual pay increases were reported for some workers, such as those in the skilled trades or in remote areas. So on net, it really wasn't a bad Fed beige book, which again is kind of weird that 10-year Treasury yields are selling off today, although the data was almost all good today. And the Fed beige book yesterday sounds a little bit better than what we thought. That should have a, hot impact on pushing 10-year Treasury yields actually higher, not moving them lower by 5 basis points. That highlights to me maybe the bond market sees something that equity markets do not see just yet. Here, about 26 minutes ago, the Israeli military chief says there is a possibility for a sharp conclusion to the conflict with Hezbollah in Lebanon. Perhaps that is an upside surprise to the markets if we do see the conflict in the Middle East start to settle down a little bit. Now, here on the day today, the percent of stocks trading above their 50-day moving average continues to decline, down to 51.81%, down 2.1% today. So 2.1% of all stocks are breaking below their 50-day moving average. You can see the RSP today is up 0.11%. This is the equal weight S&P compared to the market cap weighted S&P that's up 0.17%. Yes, it's been very volatile. We were down 1/4% at one point. We were up about 1/4% to start the trading day. So it has been very volatile, but RSP and equal weight S&P roughly in line today. The latest AI investor sentiment survey shows a sharp down move in the amount of investors that are bullish from 45.5% down to 37.7%. Neutral investors went up from 29.2% to 32.4%, and bearish investors also went up to from 25.4% to 29.9%. The CNN Fear and Greed Index is coming in today at 65, which is actually a little bit better than yesterday. Yesterday, you were at 63, so a little bit more greed in markets. Market momentum coming in greed, stock price strength, fear, stock price breadth, greed, put and call options, greed, market volatility neutral, safe haven demand, extreme greed, junk bond demand in extreme greed as well. On StockTwits, sentiment for the SPY is bearish today at 32. Yesterday it was bullish at 56. Message volume today is high at 62. Yesterday it was high at 56, and the participation ratio today is normal at 53. Here today in after hours, we have earnings from Dexcom, Deckers, Western Digital, Skechers, Edwards, Boyd, Coursera, Texas Roadhouse, Appfolio, and Kinsale. Tomorrow morning we have New York Community Bank, Colgate, Piper Sandler, Wisdom Tree, SAIA, Portland General Electric, Newell, Centene, and AON. But again, it's really next week when you get those big tech earnings where you could get more volatility to come into markets. That is my expectation. Again, with Nvidia sitting near all-time highs, Apple, Google, Meta, Amazon, Microsoft in similar positions, I do think expectations are too high heading into earnings. And I do think we're going to get good earnings, but just, well, I should say okay earnings across the board. Some are going to be good, some are not going to be as good, but overall, I think you are set up for a disappointment coming next week. Now, could tomorrow lead to, a disappointment? We'll see. That is because we do have durable goods orders month over month that come out tomorrow. We are expecting -1% on the consensus. The forecast is -0.5%. So if durable goods orders comes in bad, Wall Street's not going to like that. 1% I think already has pretty negative expectations baked into it. But it's possible you come in even lower than that. Let's say you come in at -2%, -3%. Sometimes durable goods orders can come in really negative. I think that's not going to be good for Wall Street. That's definitely not going to be a good sign for the economy. Which that does make sense why 10-year Treasury yields are falling in spite of the good economic data we got today. If in fact durable goods orders are being leaked to some on Wall Street, some of your, important firms, your systemically important firms, that would make sense why 10-year Treasury yields would be falling today. Although I really don't want to jump to that conclusion, it is a possibility that durable goods orders have been leaked and they do come in bad tomorrow. And that could be negative for markets, so watch out for that. Either way, I don't think we're set up in a favorable position heading into next week. With big tech earnings expectations the way they are, right before the election, 10-year Treasury yields that have rallied so much, I would just be a little on the cautious side. If there are cheaper hedges out there, I think that also makes sense to take advantage of. But I'm not a financial advisor, I'm not a financial planner, I could be wrong, there may never be another correction ever again in the history of the markets. At least that's kind of how Wall Street is looking at stocks, like, there's no way we could go into a correction. And when there's so much bullishness out on Wall Street, that's when I tend to be a little bit more defensive. But hey, let me know what you guys think about this information down below in the comment section. You guys have a safe rest of your day, and I will see you in the next one.